Great. All right, we'll get started. Hello, everybody. My name is Amelia Sharman. I am Director Climate Standards here at the External Reporting Board. And today the webinar will be presented by Judy Ryan, who is our Technical Advisor on GHG emissions. So what are we going to talk about today in our deep dive? We had two earlier this week on strategy, and yesterday we talked about metrics and targets for our listed debt and equity issuers, and today we're focusing on the financial sector entities. So lots of examples specifically for financial sector entities. One thing I would just like to note, we have extended the deadline for feedback on this consultation to 9 AM on Monday the 2nd of May. So hopefully that helps get feedback in, but as we have said all along, an email is sufficient. It doesn't have to be a fancy letter-headed anything. So we're really keen to just know what you think, and questions that are asked today are a very important part of it. So what are we going to be talking about today? We're just going to give a very brief overview again of the framework. We'll work through these sections of the disclosures in the order that you can see here on the slide. We will pause for questions and feedback after these sections. Please put your questions in the Q&A box or in the chat box, whatever you think you find easiest, and we'll get through those. Any questions that we don't manage to get through today, we will be capturing and either answering on our website, or if you put your name and you want us to get back in touch with you directly, we can try and do that as well. So, very brief recovery of the context. So we've got our large listed issuers who are covered, and then on the right, the large financial entities. So our banks, licensed insurers, credit unions, building societies, managers of registered investment schemes, and some Crown financial institutions. So about 200 or so entities. Noting that it is not the XRB that decides who is required to report. If you are unsure whether or not you are a climate reporting entity, please get some independent legal advice. And then if there is still some uncertainty, please get in touch with the FMA and they will be able to help you. Currently, we're anticipating issuing the standard by December. And this is an example timeframe for an entity with a 1 April to 31 March reporting date. So those first climate statements we're expecting to see in 2024. Noting the assurance timetable is not set by the XRB, that is set on 3 years after royal assent of the Act. So that kicks in from 27 October 2024 for any entity with an open reporting period that covers that. So if there's any, so that means basically from most entities' second climate statement, you will be required to get assurance over your greenhouse gas emissions, and Judy will talk in detail about what the greenhouse gas emissions disclosures are. One other thing to note here is that we are not requiring comparative information for the first climate statement, that will kick in from the second climate statement onwards. And then lastly, so just to remind everyone, we consulted on governance and risk management in October last year. We put out a feedback document in February this year. This time we're consulting on strategy and metrics and targets. We will be going out to consult again on the whole package. We're aiming for July for that consultation. And for those of you who might be interested, just today, although yesterday their time, we received the draft of the International Sustainability Standards Board entire climate disclosure, including their general requirements standard. So we will be poring over that in great detail. It is mostly as expected from their prototype, but if there are any questions, for example, about the prototype, we can answer that, and Judy will also be talking about that throughout the presentation. So just a reminder, questions in the chat, etc. I can already see some coming through. Thank you very much. We will look forward to answering those. So over to you, Judy.
Mihi Amelia, kia ora koutou katoa. So I'm planning to run through the overall disclosures and then into more detail for each section. The objective for disclosing your metrics and targets information is for your primary users to better assess your organisation's potential risk-adjusted returns, general exposure to climate-related issues, and progress in managing or adapting to those issues. For an entity, These disclosures should be about describing those metrics and targets that you use to manage your climate-related risks and opportunities. Climate metrics should inform and be informed by the entity's governance, strategy and risk management processes, and it should create a feedback loop over time in the same way that other KPIs and risk indicators are used to inform business management processes. So you'll also find that some of the climate-related metrics here are related to disclosures that you will have in the governance, strategy or risk management sections of the standard. So our proposed section of the standard has 3 sections within it: the metrics, targets and the methodologies and assumptions, and we will look at each of these. We've tried to balance principles-based disclosure, which provide you flexibility, along with prescriptive disclosures to provide comparability. And the most prescriptive areas we've been is around the cross-industry metric categories and the greenhouse gas emissions. So when we were developing this proposed standard, we drew strongly on the TCFD recommendations and guidance. This included the most recent updates that they made in 2021, which was the implementation guidance and additional guidance for metrics, targets and transition plans. We also considered a range of other resources, including the prototype that Amelia has just mentioned from the International Sustainability Standards Board, both the climate prototype and the general requirements prototype. And as she said, we've just received their new exposure draft today, and so we've got a bit of work to do to have a look at how that aligns now with what we're proposing. For the greenhouse gas disclosures, we also looked at the GHG protocol, their corporate accounting and scope 3 value chain standards, as well as PCAF, and we looked at ISO 14064, the 2018 version, and also the Global Reporting Initiative standards. And the resulting section is very closely aligned with the TCFD disclosures. So we'll go through now the cross-industry metrics. We have 8 cross-industry metric categories, which is consistent with both the TCFD and the prototype, so it can't answer to the actual standard. These are categories rather than individual metrics, and this is to allow entities flexibility in reporting while we retain some consistency between disclosures. So the categories: greenhouse gas emissions, gross scope 1, 2, 3, your intensity, transition risks, physical risks, climate-related opportunities, capital deployment, your internal emissions price and remuneration. So next, I plan to run through some examples of each of these categories from the financial sector, and we will save greenhouse gas emissions till later in the presentation, because we anticipate there may be a few questions around that. So before we get to the actual metrics, it's important to think about your metrics in 3 time horizons. So the current, historical and forward-looking time horizons. So current is obviously the current period, which should relate to your financial filings. So, if you're reporting on a particular year, your metrics should be for that same year. Historical, previous periods, don't think I need to explain too much there. And forward-looking is future period data covering short, medium and long-term horizons. So your forward-looking metrics could be based on scenario analyses, trend analysis, sensitivity analysis and simulations, as well as commitments and your targets. Often forward-looking data is more appropriately reported as a range based on assumptions rather than a particular spot. And targets, I guess, are a subset of your forward-looking metrics. You might have a forward projection of what you think the carbon price is, but you may not have a target for that. It's helpful for you to disclose the metrics consistently from year to year, so it's in order to facilitate comparative analysis and trend analysis over time. And that's also really important for your primary users, and it helps them track your progress with meeting your commitments. So the first metric that we're going to cover is the greenhouse gas intensity one. So intensity ratios express the greenhouse gas impact per unit of physical activity or per unit of economic output. So intensity ratios are often called normalized environmental impact data, and they could be things like weighted average carbon intensity, the portfolio carbon intensity. And the TCFD suggested insurance companies should disclose weighted average carbon intensity or greenhouse gas emissions associated with commercial property and specialty lines of business where data and methodologies allow. So the most common one for you guys would be an economic intensity ratio, which is the aggregating or comparing across different businesses. Transition risks, that is the amount or percentage of assets or business activities vulnerable to transition risks. So you can be vulnerable to several types of climate-related transition risks. Policy and legal risks reflecting changes in policy and litigation activity. Technology risk, such as emerging technologies impacting the competitiveness of certain entities. Market risks from changes to supply and demand, and reputational risks tied to changing customer or consumer perceptions. So disclosing this metric allows users to better understand potential financial vulnerability regarding issues such as possible impairment or stranding of assets, effects on the value of assets and liabilities, and changes in demand for products and services. So some examples: volume of real estate collaterals highly exposed to transition risk, concentration of credit exposure to carbon intense assets, the third category, or fourth really, we've missed the first one, physical risks. That's the amount or percentage of assets or business activities vulnerable to physical risks. So when considering the types of climate-related physical risks that you might be vulnerable to, you need to consider both acute risks, such as storms, floods, and wildfires that are event-driven, or chronic risks, such as higher temperatures and sea level rise that refer to the long-term or longer-term shifts in climate patterns. So you want to consider your climate-related hazards, exposure to those hazards, and your vulnerability. This allows users to better understand potential financial vulnerability regarding such issues as impairment or stranding of assets, effects on the value of assets and liabilities, and cost of business interruptions. Should be noted, physical risks are specific to geographies where assets or activities are taking place and there are likely exposure or vulnerability to that risk. So certain assets might be more vulnerable to acute risks from storms or wildfires, while others might be more at risk from chronic changes in average sea temperature, sea level rise, or drought, particularly some of the agricultural things. So example metrics in this category: number and value of mortgage loans in a 100-year flood zone, proportion of property, infrastructure, or other asset portfolios in an area subject to flooding, heat stress, or water stress, and proportion of real assets exposed to a 1 in 100 or 1 in 200 climate-related hazards, 200-year, sorry, climate-related hazards. The next category of the cross-industry metrics is the climate-related opportunities. That's the proportion of revenue, assets, or other business activities aligned with your climate-related opportunities expressed as an amount or percentage. And there are several categories of these that entities can capture. Some examples include improved resource efficiency from reducing energy, water, and waste, use of energy sources that emit low or no greenhouse gas emissions, development of new products and services, access to new markets, and improved adaptive capacity and resilience. So disclosing this metric provides insight into the position of organisations relative to their peers and allows users to understand likely transition pathways and potential changes in revenue and profitability over time. An example metrics in this category could be net premiums written related to energy efficiency and low carbon technology, and revenues from products or services that support the transition to a low carbon economy. So what sorts of businesses you're investing in. Capital deployment, that is the amount in reporting currency of the capital expenditure, financing, or investment deployed towards climate-related risks and opportunities. So this is trying to capture the extent to which entities deploy capital to manage risks and increase their opportunities. Financing by financial organisations gives an indication of the extent to which long-term enterprise value might be affected. Deployment of capital in low-carbon technologies, business lines, or products may demonstrate that an entity is investing to make their business resilient to transition risk or to capture climate-related opportunities. For example, entities that are hardening infrastructure in response to increased incidents of physical risk can signal that short-term debt might increase as the entity upgrades the assets, but that long-term costs may be lower. The example metrics in this category is percentage of annual revenue invested in research and development for low carbon products or services, and investment in climate adaptation measures. Internal emissions price, that's the price you might put on each tonne of greenhouse gas emission, and it's your internal price. It's a mechanism which allows you to put a value on your greenhouse gas emissions to facilitate your analysis of actual and potential impacts of climate-related risks and opportunities. Financial organisations could use a carbon price to inform their decision-making by considering the impact of a given carbon price on an organisation's profitability as part of the investing, lending or insurance underwriting process. Internal carbon prices also provide users with an understanding of the reasonableness of your risk and opportunity assessment and strategy resilience. It can help users identify which organisations have business models that are vulnerable to future policy responses to climate change and which are adapting their business models to ensure resilience to transition risks. There is no definitive source on what an organisation's internal carbon price should be, and there are a variety of ways that you could calculate this, and it could be integrated into your practice. The TCFD gives two examples of metrics: internal carbon price and shadow carbon price by geography. And then the last metric is a remuneration metric. So how much of your management remuneration is linked to climate change activities? A percentage, weighting, description, or a dollar amount. So remuneration policies are important incentives for achieving an entity's goals and objectives, and they can provide insight into the governance, oversight, and accountability for managing your climate-related issues. The way that you link your executive compensation to performance on issues related to climate change is specific to your entity and your governance structure. Some choose to report the percentage of the executive's pay linked to climate considerations, while others discuss weighting factors or total amount of compensation that could be impacted. So some example metrics here: portion of employees' annual discretionary bonus linked to investments in climate-related products, weighting of climate goals on a long-term incentive scorecards for executive directors, weighting of performance against operational emissions targets for a remuneration scorecard. Now, conscious we haven't covered the greenhouse gases, but we have promised we will come back to that shortly. So, questions?
Thank you, Judy. Lots of questions. So we'll just try and focus here on the lots of questions on emissions. We're going to hold those and get back to those later because we know they're really of interest to everyone. So just a quick to repeat. Can you please repeat what insurance companies should measure in terms of intensity? That was up in slide 11, Judy. GHG intensity metrics for insurance companies.
One moment. Weighted average carbon intensity or greenhouse gas emissions associated with commercial property or specialty lines of business, where data and methodologies allow appreciating that actually the insurance category is one of the slower off the block in terms of getting some good methodologies and standards going with that.
And another question is, did we consider the GHG protocol scope 2 standard as well? If not, why not?
Aha, can we get to that one when we do the greenhouse gas stuff? That's
Absolutely.
A good question, very good question.
Another question, just we've got loads of questions. What are you using to define low, medium, high vulnerability? The MFE guidance notes that councils use, and what are you doing vulnerability, exposure, adaptive capacity for assets? Vulnerability is only one component to consider in physical risk exposure.
Super good question, and I think actually we're going to bat it back to the entities themselves to define how they do that, because we can't really set, I don't believe we can set a standard that would be applicable right across, so we are relying on entities to tell us what or how they've defined stuff, and you'll note, actually we'll get to it later, but we're talking about methodologies and assumptions. So when you've disclosed a metric, you need to sort of give a good precise summary of how you defined that, how you defined vulnerability in your situation.
And building on that, a similar question is, do we intend to provide guidance around intensity metrics for different sectors? Particularly for banks, there are lots of different ways we could define economic output.
So I would say no, at this point in time we don't. You choose. we're really strongly encouraging at this stage of the maturity of this whole area that people should find metrics that work for them for management purposes and then tell us what they are and what they're using. So really that's our key. We are not going down the road of defining different ways of doing it. There are other materials and places that you could look to. You obviously know of a few because you've referenced the fact that there are multiple. The international prototype, or now standard, is likely to have picked up the SASB standard requirements, we think. So that could be a good starting point. But New Zealand entities can be slightly different to international entities. So we want you to tell us what you're using and how you're defining that.
So yeah, so while we won't be prescribing it at this stage, we for all the reasons Judy said, we will be putting some indications of where you can look in our guidance to find some of these examples. But yeah, it's about choosing the one that makes sense for you. And if over time we see that there isn't comparability and it's really difficult for investors to understand all these different metrics categories, we can be more prescriptive. But at this stage we have decided to align internationally and be as flexible as we can at this point. One other question which says, do you expect these metrics to all be disclosed in the metrics and targets section or in strategy, as there seems to be heaps of overlap with the latter?
Absolutely, there is. I mean, these are the metrics and targets by which you measure and manage your strategy. So yes, no, we're not creating a presentation standard that says you must show it in a particular fashion. So it's up to the company to present them in the way that makes the most sense for them. So if they're metrics related to your strategy, then there's nothing stopping you putting them in your strategy section. You might like to put a little table maybe that would tell people where to find them within your strategy section, but that's entirely your choice, I think. Amelia, you would agree with that?
Yeah, absolutely. The key thing is to think about your primary user. When you're presenting your climate statement and the information in it, what is the way that's going to make most sense for your primary user to understand it? This is new. It hasn't been around for the many centuries as the rules around financial reporting. So at the moment we're being very, very flexible, and that's where we think is a good place to start. Now, lots and lots of questions about emissions, but we'll just take one last one around some of the metrics, which is, did we look at metrics needed for a bond issuance versus a bond issuer?
Good question. To be honest, Erica, I'd have to come back to you on the detail on that one, but we're largely pulling on TCFD guidance here. So yeah, we would need to go back and have another double look. Can we come back to you on that one? We've got your name, so hopefully we've got your email address, and I'll try and put some more comprehensive reply together for you on that one.
Awesome, thank you, Judy. Okay, so yeah, as I said, lots of questions on emissions. Let's race through and get to those. Thanks, Judy.
Cool. So the next section that we wanted to cover was the industry-specific and entity-specific metrics. I don't think entity-specific needs much more explaining. It's whatever you create for yourselves. But the industry-specific, we are not proposing to specify industry-specific metrics. As we've said, we want people or entities to report those metrics that they use for management purposes. We don't think there's any value in reporting metrics that you don't use or that your primary users may not be interested in. So you need to have a good think about what you're using for management and what your primary users would expect, and then stick to that rather than we didn't really want to create that long shopping list. The TCFD implementation guidance does provide some recommended sector-specific metrics, which we'll take a look at. And the International Sustainability Standards Board, in their prototype at least, had proposed a very extensive list, which was drawn from the SASB standards. And we've got information on how to find that source in our consultation document, if you're interested in that. So these are the potential metrics identified by the TCFD in its supplemental guidance for the finance sector. So while we're not specifying how to measure these metrics and that they're metric categories, we would expect that there'll be some consistency and pressure over time for entities to use similar metrics when they're in similar industries. So we are expecting that there may be some consolidation over time, and at some point in the future, it's possible we may be more specific in this place. But again, it's new and developing, so we didn't want to back a horse at this stage where we didn't know where it might end up. The one metric that you'll notice is consistent across all of the categories in the financial sector is portfolio alignment. And we've had a few questions over the last few days around the similarities and differences between portfolio alignment and scenario analysis, which I'm now going to attempt to cover. Scenario analysis is my colleague Jack's specialty, and he's trying to school me up, but hopefully this will make sense. So portfolio alignment is a tool for forward-looking analysis that assesses the alignment of your portfolio with a specified climate target. So you've picked your preferred future, 1.5 degrees, and then we are assessing our portfolio about whether our current portfolio would get us to that target. So it is not the disclosure of your scope 1, 2, and 3 emissions. And it's not scenario analysis. Scenario analysis is about an exploratory process where you dream up some different futures and you test the resilience of your strategy. Whereas portfolio alignment is saying we are going to try and get to that point, this one particular point in the future. So hopefully that makes sense to people, but that's the difference. It's kind of subtle, but really important difference to understand. And at that point, I'll stop, see if anyone's got any questions.
We've actually, all the questions are related to emissions. So I think we'll move
keep on going.
Keep going, and we'll get to those questions that everyone is keenly interested in.
Yeah. So this section's about the targets. And so climate-related target is your specific level, threshold, quantity, or qualitative goal that you wish to meet over a defined time horizon to address your climate-related risks and opportunities. It's a mouthful. So pretty much these targets should be informed by your strategy, your risk management, and they should be aligned to your metrics. So sometimes you might choose your metrics first and then define your targets that help you achieve your high-level strategy, or you might set a target in the case of 1.5 degree future and then work backwards to figure out what your metrics and how you're going to track your progress against that. The disclosures for targets that we've required proposed have been drawn from the TCFD recommended disclosures in their metrics and targets guidance section. We have added an additional disclosure for the science-based targets drawn from the prototype. And this is becoming an increasingly common benchmark, I guess, for emissions reductions, but in particular. And the prototype itself had other additional disclosure requirements, which we did not include in our proposed standard at this stage. The TCFD believes that organisations should be able to have targets related to each of the 7 cross-industry climate-related metric categories. We have not required that, so you use the targets for those areas where you want targets, and they have included some examples of what they think the targets could be like for each metric category. Don't think I really need to read them out, but they're there if you want to have a look at them later. And then the methodologies, this is probably one of the key parts of methodologies and assumptions section. This applies to all of the previous disclosures in this section. So the key point for this is for primary users to understand the level of estimation and uncertainty in your key metrics and how you got to where you got to. So the sorts of things we want, and we're not wanting a 10-page book, a nice concise summary of the methodologies, definitions you use, except when they're screamingly obvious, including the scope of application, where you got your data from, any critical stuff that makes material, I should not use that word material, makes a big difference in the output. So if your metrics come from scenario analysis, say so, which scenario analysis did you use? If you adjust the methodology that you use to calculate your metrics over time, then when you make those changes, you should be telling your users why the number has changed and what's changed about the methodology. And we realize that this particular space at this particular time has heaps and heaps of uncertainty. So where you've made some pretty bold guesses, that's fine. Just tell people about it. It's about disclosing that level of uncertainty. And that high level of uncertainty doesn't always prevent, an estimate from providing useful information. It can give us a scale. We all know, I'm going to dive into greenhouse gases, but not really. So the scale of your emissions, it's not an exact science. It's not going to matter if it's 1 or 5 out, but if it's 5,000 or 50,000, that's an important distinction, and that's the sort of where we're trying to get people to think about here. So greenhouse gases is the next, but do we have any questions on this section or up to here?
We do. So we've got a question which is, are we going to define science-based target? And I can just see something that's just popped up on the chat, which says, yes, targets, 7B, whether the target is science-based. We don't appear to have defined science-based. Why?
Well, we haven't defined science-based. You're right. Perhaps we should. Most people will, some of the people at the moment are getting endorsement from the SBTI, Science-Based Targets Initiative. So we would expect that they will want to put that in there if they have. If they're science aligned, they might like to say. There's been people that have done work, I know Toit, who have often helped people assess whether their targets are aligned with the science. So that we are not providing assurance at this stage over the disclosures. Ignore the greenhouse gases, just ignore the greenhouse gases over the rest of them. But entities or organisations may wish to get their own assurance over other disclosures. And so that is something that an assurer would pick up if you made statements that weren't true without defining it, as long as you can tell us how you've defined things. That's the key, the methodologies and assumptions. So I'm saying I have a science-based target because it's been endorsed by the SBTI, then that's a pretty simple explanation. If I've calculated it myself, then I might have to give some more words around that space.
I think one of the things, we are very aware of is that the disclosures do require a decent level of understanding from the user, to make sense of it. And we absolutely expect that capability will increase rapidly as the disclosures come out, as people look at them, see what's different between the climate statements. And as I said earlier, we want to be principles-based, we want to be flexible at the moment. We don't think it's our role to kind of set everything in stone at this point. But over time, if we feel that some of the stuff needs to be more prescriptive, we will keep looking at that. And then a slight incursion into emissions, Judy, but are we requiring targets for scope 1, 2, and 3?
No, we are not requiring targets for anything in our regime at all. It's up to an entity to specify those. However, your primary users might be surprised to find you don't have a target for scope 1 and 2 at this stage of the proceedings, but that's just my humble opinion. That's not a requirement in the disclosure.
Excellent, thanks. All right, let's move on to emissions, and we will get to lots of these questions that we've got.
Picking up there. Okay, so greenhouse gas emissions disclosures. We have used the term gross greenhouse gas emissions rather than absolute. The TCFD uses absolute. And in the prototype, the International Sustainability Standards Board used gross absolute. The intention is that entities should report their emissions before any trades, credits, or removals are applied. And this includes accounting for scope 2 emissions using the location-based methodology. So this shows the total emissions that an entity is causing. And we believe it's transparent, and it helps to focus attention on emission reductions rather than offsetting, which is not as, we all need to reduce emissions. We might need to offset as well, but we definitely don't want to focus on offsetting. This approach is consistent with the GRI standard 305, and we have made gross a defined term. However, entities can provide additional disclosures, such as market-based emissions, if this is how they manage and measure their climate-related risks and opportunities. So I did see a question around the why not scope 2 market-based, and absolutely, we're not stopping you doing that. If your greenhouse gas reduction target includes a scope 2 emission that is market-based, that's fine. You'll have to do both. You need to disclose location-based and market. You can optionally disclose your market-based as well. The GHG protocol and ISO both say you should do both. So we've set the minimum, and you can go over and beyond that if you want to. We have also talked about the scope 3. So scope 3 value chain for all entities, and that's the yellow arrows shown on the screen. For financial institutions, the biggest and most problematic category is way out there on the right top right of that arrow, and that's the investments. So that's where most of your action happens. And the Scope 3 categories, though, under the Greenhouse Gas Protocol, there are 15 of them. They're all itemised there. I'm not going to read through them, but they basically run from, you know, the purchase goods and services you buy, the production of those, the getting them to places, the what you use on site, and the downstream effects and end of life disposal and all of that sort of stuff. So it's pretty big and pretty full, and it's an area with a lot of uncertainty in it, but it is where the biggest risks and opportunities lie. So for a normal entity, for a non-financial entity, the Scope 3 is around about 11.5 times bigger than their Scope 1 and 2 emissions. So it's pretty significant if you measure your full value chain. And for financial institutions, it's 700 times larger than your operational emissions. So big, but appreciate this is it's a pretty hairy area to measure at the moment. So in the top of this graph, this is a CDP graph. It's not very pretty, but it shows those 25% who are measuring their Scope 3, and the ones below them are the people who are not measuring Scope 3. So you can see that, and they've changed the scale of the graph up to try and be able to show them. Basically, to achieve a net zero emissions by 2050, we need the whole economy to transition. Every company, every bank, every insurer, every investor having to adjust their business models and develop credible plans for the transition and implement them. So finance is funding the initiative and innovation of these plans, provided that it has the necessary information, tools, and markets. So the whole point of all of these disclosures is shifting the capital allocation to the right parts of the economy to help us meet that net zero 2050 goal, or the 1.5 degree future that we all would prefer. So it's the financed emissions, and agreed, you know, that is a pretty difficult category to measure at the moment, and we appreciate that, but it's a starting point. And it's the starting point to manage your risk and identify opportunities associated with businesses that you're investing in, and also the tangible first step to building trust that financial institutions are integrating climate change into their core business of providing capital. So we have made some additional requirements for our greenhouse gas emissions. Our standard is primarily a disclosure rather than a measurement standard. So we propose that when we recognise that there are existing globally accepted and commonly used greenhouse gas emissions measurement and reporting standards, which include the Greenhouse Gas Protocol and ISO standards. So we're not mandating which one of those standards, or which standard, in fact, that you use at all. As long as you just have to tell us which standards, protocols, and methodologies you've used. We propose that your entity prepare a separate greenhouse gas emissions report, and selected extracts only from that report are disclosed in your climate statement. In addition, we've proposed some additional disclosure requirements. Well, we've clarified what selected extracts, I guess, from that report we would like to see in our climate statement, and these are to provide greater comparability for primary users. So one of these is the consolidation approach. We haven't required a particular consolidation approach. If you're familiar with measuring your greenhouse gas emissions, you'll understand what that is, but it's this equity, share, operational control, or financial control. The choice of yours is whatever works for you, but just we need to know, or you need to disclose in your climate statement which you've used. We believe that actually they don't make a material difference as long as you're measuring your whole value chain, which we're asking, then the numbers will all be at the bottom, and they just move between scopes, the emissions. We've also required disclosure of the source of your emission factors, your global warming potential rates, and what's excluded, a summary of. We believe that these, along with the consolidation approach, are the material, I shouldn't use material, are this key information that primary users need to understand how your emissions have been calculated without having to refer to your greenhouse gas emissions report, which they can go to for further detail. The emissions disclosures are required to be assured by legislation from the October 2024. So for an assurance opinion to be formed over the disclosed greenhouse gas emissions in the statement, the information needs to be prepared and reported in accordance with suitable measurement criteria. That's why we've required that a greenhouse gas emissions report is prepared in accordance with generally accepted methodology to support those emissions. So our proposal is that an entity would prepare a greenhouse gas emissions report, and it would be linked from within the climate statement and be made publicly available. So we have defined the term that talks about what we expect. That's referring to the recognised standards or methodologies. The most common GHG protocol, that's both the corporate value chain and the Scope 3 accounting standard. The ISO 14064 Part 1 2018, which again now includes the value chain. And for financial institutions, there's the PCAF accounting standard, and they are working on the assurance standard right now, and we were hoping to have heard back from our colleagues over there overnight. The project is underway and we are remaining in touch with them about how that is progressing. I have put some examples of inventory reports up there. They are none of them financial institutions at this point in time. And the last thing I wanted to cover was the assurance. So again, this is under the legislation. There are two possible levels that we could have chosen, either reasonable or limited. Reasonable is the highest possible assurance. So if you're reading a reasonable assurance report, it is stated in the positive. In my opinion, the greenhouse gas emissions are fairly presented. Limited assurance, the conclusion is in the negative. Nothing has come to my attention that would give me reason to suspect. So we are proposing to specify a minimum level of limited as part of the initial climate-related disclosure framework. So we think that this is a developing area. We understand that there's difficulties, and we're working really hard to figure out how this assurance regime can fit alongside the required disclosures. We are also expecting that over time, as practice consolidates, that we might move to reasonable assurance, and or that the assurance could be over the entire climate statement, potentially. So, but at this stage, for the first draft,
clarifying that the assurance, the scope of the assurance is set in legislation.
Yes.
So that is something that that MB, MFE, etc., would be deciding on. We are proposing that it is limited to start with.
Yeah. Sorry. Thank you, Amelia. Yep.
That's okay.
Right. Some greenhouse gas questions.
Woo, lots of questions. All right. Some very short ones. We'll just whip through. So if we have all the contents of a GHG report available easily in other documents we need to link to, why do we need to create an extra document? You do not need to create an extra document. If you're already producing a GHG emissions report and it meets, the criteria, then absolutely you can just link to that existing report that you already produce. I did just put a link in the chat to a webinar that we ran with PCAF late last year, which might give you some more information on PCAF. So hopefully that will help. Now I'm going to go right back up. And then one last one. How do the proposed standards permit and encourage use of charts, diagrams, tables, etc.? So the prescribed descriptions, metrics are more understandable and meaningful. You can absolutely do that. The XRB is not going to prescribe how your climate statement should look. It should be meaningful and understandable for your primary user. So it's really important, I think, to think about who is the primary user for your disclosures, who is your existing and potential investor, lender, or other creditor, and make it meaningful for them. All right, so those are some of the easy ones. Judy, let's start back. So thank you. We got some questions right at the start, so I'll go back up to those. Is there any taxonomy or guidance you might issue for general insurers to help quantify underwriting emissions? This is a space that still seems a little complex and underdeveloped.
Yes. Yep, it is. And so we're keeping an eye on that space. PCAF are working to developing a standard for insurance at the moment. So we're very hopeful that that isn't very far away. And as I said, we're remaining in touch with them on that. So that would be my first port of call on that one.
And then I think a question here. This person says, I understand the need for financed emissions, but should this include financed scope 1 and 2 emissions or also scope 3 emissions? Or should we just follow a methodology, i.e. PCAF gradual introduction?
Yeah, I would follow PCAF gradual introduction. PCAF have 1 and 2 for most categories, but some they have gone 3. The difficulty with 3 is it becomes a rabbit hole because 3 is 3 is 3. So 3 is, if I'm counting scope 1, 2, and 3 of my suppliers, and they're counting in their scope 3, their suppliers scope 3, it's a rabbit hole. But I would definitely stick to PCAF. Their guidance is pretty good, I think. for how to calculate those scope 3, and based on different categories. So some of their categories, they've very, very clearly said scope 3. And just one more thing, kind of difficult because your emissions can end up in scope 3 if you outsource key functions. So if I outsource all my maintenance, then all of my maintenance emissions are in scope 3, but actually I couldn't run my business without them. And so that's where that categorization becomes really difficult, I think, for what should be in and what should be out.
Yeah. And just one thing I wanted to cover, two points here about, this applies to the whole, all of the disclosures. As Judy said, this is primarily about disclosure. We want you to disclose what it is that you're doing. We want you to disclose, those methodologies and assumptions disclosures are really important. If, for example, you are not using a target to do X, Y, Z, you do not, you disclose that you are not doing that. The second one is about materiality. I highly recommend that everyone goes to the consultation document, looks at that materiality section. Critical part in that is, the disclosures should be material for your primary user. And we are not specifying a uniform quantitative threshold for what is material. So, for example, we're not saying, 1 tonne of greenhouse gas emissions is, under that is not material or more material. It could be hugely material if you don't have many emissions in a certain area, for example. But yeah, that materiality description is really important. So, back up to the top of this long list of questions. What should we do about emissions not currently covered by PCAF, i.e. customer lending, credit cards, etc., not mortgages or vehicles?
Yeah, so I think we recognise that this is a developing area. You could take a shot at them, or you could, it's pretty hard to answer, I think. So I think I would be just talking about what is and what is not counted in your profile at this point in time.
Thanks, Judy. A question here, kia ora. What is your thinking around scope 1, 2, and 3 versus the new ISO 14064/2018 standard, which now breaks emissions down further into the 6 categories?
Yeah, so the ISO categories that they break, they use 6. Greenhouse gas scope 3, the corporate value chain accounting standard, actually has 15 scope 3 categories, which are subcategories within ISO. So the 2 standards are very, very closely aligned. And actually, if you need guidance, better guidance is in the greenhouse gas protocol scope 3 guidance document, or their standard. But the ISO has a nice easier to follow reporting because they've crystallized their reporting requirements much more easily. We haven't specified, and I think they both deliver pretty much the same result. So we're allowing companies to do use which one of those suits them best, but they will need to disclose them as scope 1, scope 2, scope 3. But those are pretty easily translatable from the ISO standards. But if I were doing my own, for my things here, I might look to provide an explanation about what is and what is not in my scope 3 categories.
Thanks, Judy. Hold on, that's the same question. We've got a couple of questions around underwriting emissions. So one question is, given there is no methodology for calculating underwriting emissions yet, isn't it too soon to require this from day one? And another question says, in your previous presentation, you make reference to underwriting and financed emissions. However, the standards around scope 3 emissions often exclude these. Does the XRB expect that insurance companies will need to disclose underwriting emissions and banks will need to disclose financed emissions?
So the last part of that question first, yes. The first part, yes, it's a developing area. We realise and appreciate that. We've asked we want to include it because it's really hard when we start trying to carve out just tiny little bits and pieces. So just say that it's a disclosure standard that you were unable to calculate underwriting emissions, and that we think that this might represent a significant risk or not for our climate-related risks and opportunities. I mean, that's about trying to assess that risk, even if there's no methodology for calculating it properly. You might have an idea of the size of the pie, and that could be good enough.
Thanks, Judy. I'll just click answer on all these.
Trying to figure out where you are on the list of questions.
A lot. Thank you so much to everybody for your questions. They're absolutely brilliant. So, where a company acquires a new subsidiary, what are your assumptions around how quickly GHG reporting needs to be updated to include the emissions of the subsidiary?
Yeah, so pretty much when they get incorporated into your financial statement. So we are aligning our disclosures with your financial reporting periods and for those entities covered from within your financial statements. Don't acquire them on this, so maybe at the beginning of a financial year would be helpful. So yeah, it needs to be in alignment, or you need to be able to explain why their emissions might not have been material if you acquired them on the last month of the year. If they were not material, if they were, then you should be looking to disclose them right from the start.
Thanks, Judy. Question here. Is Scope 3 downstream also appropriate for fund managers given the significant double counting?
Absolutely, it's appropriate. We are trying to be able to, for people to understand the emissions that are being funded by fund managers for where they're choosing to put their funds. So yeah, and Scope 3 is double, triple, quadruple counted. It does not matter in the slightest. It gives a view of the amount of emissions that an entity is supporting throughout the economy.
I think, and we had a question yesterday in our deep dive around, would it be, this issue around double counting, and would it make it hard to get a clear sense of the total emissions of an industry, for example? And one of the things we wanted to clarify is, it will not be possible from to aggregate all the emissions reported in these climate statements and say, hey, here are the emissions of the agriculture sector, or the whatever sector it might be. For some where there's quite a defined list, and pretty much everyone in the sector is in, maybe they could do that, but there's so much uncertainty around what is in, what is out. There's no kind of collating up at the moment that we can see happening.
And with Scope 3, you can't really ever collate up anyway. So you can only ever collate up with Scope 1 and 2. I mean, Scope 1 should only be reported in one entity's Scope 1 ever.
Okay, so the question is, do we recognise the challenges and risks in disclosing estimated Scope 3 data, which then gets significantly refined as methodologies develop, i.e. especially for underwriting? This is especially true when companies have international parents which report aggregated emissions.
Yep. Yes, it's going to happen. It's going to happen to all of us. We're going to start with high-level estimates, rough estimates, and work to refining them over time. And I think that's when we talk about methodologies and we talk about changes in our methodologies and we explain the differences between what you can see. But yeah.
All right. Got a question here. Scope 1 emissions of clients that banks lend to will form part of that bank's Scope 3?
Yes, that's correct.
Yeah.
Sorry, that was me figuring out that, yes, that's correct.
And we've got two, I think, quite similar questions. One is, can the emissions reporting year be different to the financial reporting year? And the answer is no. Unfortunately, it cannot. That is set in legislation. That is not something that the XRB has any control over. And then the second is, can your GHG emissions report be different to a climate reporting entity's financial year, or does it require alignment? And again, the answer is no. We do understand that there, for example, for the emissions trading scheme, there are different emissions periods, and you may have a different emissions period, for example, if you operate in another country, but that is something that is set in the legislation. So if you're annoyed about that, contact MB and see if you can get that changed. Right, done that one. Right, sorry, I missed from right at the beginning, my apologies. How should we approach the Scope 3 emissions of our borrowers, i.e. the Scope 3 emissions portion of our financed Scope 3 emissions, given there is very limited data for this?
Yeah, difficult, isn't it? As best you can. That's about all I can say. That's not very helpful, is it? So PCAF does give some good guidance about when and how you should include stuff and how you should go about getting it. And you might find, we're all in this together, the famous saying, but I think that more people will be starting to measure their emissions, which will help us all make better disclosures over time. And so no one's expecting perfection on day one. I think we've even had the FMA on record as saying that. So We have it, you heard it, we recorded it. So we just need to get people started. And so agreed, it is difficult, agreed there's some uncertainty, but we need to get moving down this road.
One comment here that we have, there are no first-time adoption provisions for metrics and targets, which is tough for category 15.
Yes, it is. I don't know what to say there. Yes, it is. As I said, we want people to get started. We want you to get started now, but it is a proposal. It is out for consultation. So I'm happy to have that point. I've picked up that point here that you think it's difficult. We've had lots of discussion and questions today about how difficult it is. So we will be taking that on board. But yeah, if you feel really strongly, please let us know. That's why we're out for consultation now.
One of the things I would note is that, you know, the assurance timetable is set in legislation. We are super keen that everyone gets at least a year of giving it a go, trying to do your emissions before you have to get assurance. So that's one of the reasons why we went out where we think. Sorry.
I was going to say, what's why we landed where we did. We're very conscious that year 2 is going to be subject to assurance, and that includes all of this stuff.
Right, okay. For the New Zealand division of an Australian company, assume that we are comfortable that the GHG inventory is for group data with New Zealand data included?
It needs to be for the climate reporting entity for New Zealand. So it needs to be a New Zealand inventory report for the New Zealand data only.
Yeah, so as
which you should be able to extract relatively easily from your Australian group, but it does, in the legislation, it needs to be for our climate reporting entity. So yeah.
So if it is possible in any other report that you produce to very clearly see the emissions associated with the climate reporting entity, then you know that would be fine. But it's about clarifying that it is for the climate reporting entity in New Zealand. Do you expect that as our methodology is refined, that comparative information are restated?
Yes, that would be good practice. And you might, not every year, probably, if nothing much is changing, but when you have significant changes, your comparative information should be restated. In the greenhouse gas space, there's some guidance in both ISO and the GHG protocol about what might trigger a restatement. But for the other metrics, the same thing applies. If you want to restate them, you just need to you should, so that they're comparable over time, but you should also explain what you're doing. If it's worth it. If it's really super hard and it's not going to add any value, then don't.
Great. I think we've got time for maybe 2 questions. So have we thought about emissions associated with insurance cash settlements? That's an interesting one for me. And to what extent should this be included in GHG reporting?
To be perfectly honest, not at that level of detail, no. But yeah, it probably should be. And it depends if you think it would be a significant and material category in relation to all of the other stuff that you're doing, and you might find that actually it's not, or maybe it is, and you should try and figure out some way of calculating that. I know some insurance companies, you know, if you provide vehicles for loaners while cars are being repaired, you know, that sort of kilometerage and fuel usage might be relatively easy to track. So that would be a starting point for some of that.
Right, and then one last question, which may not be relevant, but interested to hear your thoughts on greenwashing and how New Zealand might manage this risk. Seems like a space that is not currently regulated, you're right. I see ASIC in Australia is now looking into this. Would this be an MB or FMA question? So the answer is we are super interested in greenwashing. We spend a lot of time thinking about how do we balance that trade-off between comparability, which helps to limit the risk of greenwashing, and meaningfulness. You know, we want these disclosures to be both meaningful for you as reporting entities and for the primary users that actually can understand, you know, what it is that you're actually doing. So there's lots of other ways that greenwashing can be reduced through the use of taxonomies, for example. So yeah, we are having lots of discussions with other parts of government that are doing work on this in similar areas. But yeah, it's not at the moment, you know, the XRB is not going to come out and say, you know, this is green and this is not. But, you know, we know of a lot of work that's going on also in other jurisdictions. So we're keeping a close eye on it and thinking about how it might interact with our regime. So I think we're out of time. Thank you so much, Judy. Thank you so much, everybody, for all your questions. They were brilliant. I think we managed to get to the main questions that all came through. If you have any other thoughts or comments, please contact us at Climate@XRB, follow us on LinkedIn. Or I think Erica will get back to you, especially with your curly questions. Love a curly question. So yeah, and looking forward to your feedback on the disclosures. So thank you very much for your time. Mā te wā.